All right, we are connected for the Monday edition of the News Update. And as always, looking forward to connecting, sharing my 2 cents on a variety of subject matter. And it looks like there's more rethinking, de-dollarizing, as well as, I guess, positioning for the future. And it has nothing to do with the US Treasury. So we're going to talk about that and a lot more. Looks like gold and silver is having somewhat of a better morning to start the week off. And so we'll see how things go. Lots of key metrics coming out this week that will definitely, I guess, give a more detailed viewpoint on the American economy. And so we're going to talk about that and a lot more. But as always, for those who are plugged in, if you have not as of yet, definitely check in with the boy. Make sure you subscribe, hit that bell notification so you stay plugged in, drop a comment or share some thoughts, ideas in the comments. Definitely would love to check in with you guys. And we're going to go through a couple different headlines here. I'll just share my 2 cents on it, try to, I guess, make sense of all this noise that we're experiencing. And there's all types of topics we can touch on. But just pay attention to what matters most at the end of the day. And that's what's in your pocket, I believe, and how it impacts your future and everything in between. So let's jump right into it. Let's not waste any time. I wanted to look at the charts a little bit. We'll look at early morning activity in the markets. And of course, keep an eye on gold and silver, of which silver being the most important monetary medium. And it looks like the Crimex might be up to something new with trying to further, I guess, confuse as well as manipulate the markets by offering smaller contract sizes for the retail investor to get involved with, to speculate on. So it's going to be interesting, man. But definitely let me know where you're watching from. Definitely love to check in with you guys. And as always, from good old sunny Michigan this morning, it looks like, let me just share with you what's happening in my neck of the woods. So as of right now, it's 14 degrees. 14 degrees and the sun is out in Detroit. So, it's cold. And the snow hasn't went anywhere, man. It hasn't even melted. That sucks. But it is winter. So what am I surprised at? Don't know. Let's just jump into it. So here on the screen, let me give you the price action of what I'm keeping my eyes on. So as of right now, it looks like silver and gold is off to a good start. Crimex is open, $82 silver. And as you can just look at all of this, the wild, volatile swings here. Start off early, takes a dip, tries to recover, takes another dip. And the fact that gold and silver are somewhat mimicking each other with the up, down, up, down, up, down. And the thing is here, it's only after 10, and it's just a matter of time before it either continues up or it comes down again. But once again, this is the spot price. This is what the papers market is based upon, not reality. Because as I always say, just go check at your local coin shop, and I'm sure you'll get a much different price that is higher than this. And one thing I find interesting also with this is, let me just share with you. So here we have something that's different that over the last several weeks we've had, I guess, China in the hundreds with India following behind and the US lagging. But as of right now, as you can see, it's 82 US spot on this chart here. Shanghai benchmark closed at 87, and then India is 82.80. And so the premiums or the spread between all three of these primary exchanges that set their own prices, they're all in the same ballpark. They're all in the 80s. And this to me is different because it's relatively new. And so it puts them all somewhat at an equal par. And my assumption would be that all of this has everything to do with trying to quiet and minimize the pressure upon the vaults. Because I have several tabs that I've been looking at where the Shanghai exchange, their vaults is just bleeding silver, tonnage is leaving regularly. Then, of course, everyone is suspecting the Crimex has no silver or nothing that's readily available for delivery. And then, of course, with India, we know how important metal is there, whether it be gold or silver. So it's good to say everybody's trying to get access to physical. And these prices here reflect the fact that I think they're trying to somewhat contain the price side of things and keep it below 100 so that it doesn't excite more of a new audience, driving people in, trying to get physical, putting even more pressure on them. So we'll see how it plays out. Once again, this is all relatively new, and it's only February. It's the beginning of February. So it's good to say as we move further along in this year, we'll get more understanding as to what's real. But in the meantime, getting physical is your best option in a world of digital distractions and paper disruptions, as I would like to call it. Okay, so I'm going to go through a couple of things here. Primary thing is the West-East narrative, China, US, and of course our debt. It's all centered around our debt. And right now over on X, what's trending and what's worth touching on is China urges banks to cut US Treasury holdings amid risk concerns. So think about this. You have another nation that has been very accommodative and supportive of our debt binge for the last almost 30 plus years, given the fact that we have issued unlimited debt and we've received goods and services, i.e., everything made in China. But the tide has turned, everything is shifting. And with this particular narrative here, this lets me know what the sentiment within China is when it comes to their viewpoint on American liabilities. And so I'm thinking about, okay, so if China's telling their banks to start dialing back on holding U.S. liabilities, U.S. Treasuries and our bonds are literally the primary mediums of which these instruments here become the derivatives of. And so the less of those they hold, the greater risk within these, because who's going to be the buyer of those to support this? That puts more pressure on the Federal Reserve, to where the Federal Reserve will now have to step up its efforts, of which, as far as the what's it called, what's his name, Jerome Powell's reserve management that he's undoing right now with 53 billion a month to be supportive of U.S. liabilities, buying back U.S. debt. They're going to have to step that up. Therefore, that is quantitative easing type metrics, which will only increase. Therefore, creating more units, expanding the monetary base, and ultimately positioning us to where we're going to have greater consumer prices down the line. It's just no way around it. The greater the monetary base, the more it's going to impact the actual users of those currencies in a variety of ways, including what we would consider inflation, which is ultimately just increase in prices of goods and services when it comes to the CPI figures. So let's get into this. Let's get into this a little bit. I want to dive deep into this because this is not a good way to start the year off at a time where the U.S. has to roll over close to $9 trillion in debt. But here is an article from Bloomberg that highlights more of this. It says China urges banks to cut exposure to U.S. Treasuries. Let's jump into it. So it says China regulators have advised financial institutions to rein in their holdings of U.S. Treasuries, citing concerns over concentrated risk and market volatility, according to people familiar with the matter. It says officials urged banks to limit purchase of U.S. government bonds and instructed those with high exposure to pare down their positions. The people said, asking not to be identified, discussing private deliberation. So not only should they dial back, but they should begin unwinding and redeeming, releasing, giving back those same instruments to their initial creators, which is the Federal Reserve, or put them on the market to sell them. And in return, get dollars for those debt instruments so that they can spend them more than likely. Because it's good to say by dumping the debt, you're not going to dump the debt into the currency that you're also concerned with and not let go of the currency. So clearly, that currency will be utilized in another form of fashion. And of course, gold will be the primary medium, I believe. But it says here, communicated verbally to some of the nation's biggest banks in recent weeks, the guidance reflects growing wariness among officials that large holders of U.S. debt may expose banks to sharp swings, the people said. The worries echo those made by governments and fund managers elsewhere amid a brewing debate over the safe haven status of U.S. debt and the appeal of the U.S. dollar. So what's being brought into question, and which has been in question for quite some time, is the safe haven status of U.S. debt, one, and the appeal of the dollar. And so when you look at a chart such as this, bring it on the screen here, when you look at the fact that we have a number that cannot stop, a government that cannot do anything other than borrow, it's good to say this right here provides no confidence whatsoever for anybody. It's a lose-lose for whoever relies upon U.S. debt, and it's a derivative, which is the currency. And so it only will increase the pressure to dump and to get into something tangible and real that has been tried, true, and tested for quite some time. And that, of course, is gold and silver. So the U.S. in of itself has backed itself into a corner where they have given the world every single reason to begin rethinking, de-dollarizing, as well as redeeming U.S. liabilities and get into something else. So it's inevitable. And so that's why, regardless of the spot price of gold and silver, whenever you look at the screen, we're in the beginning innings, or it really hasn't even started yet to where it could end up going as more nations jump on board, because China is the biggest nation that can actually begin the resistance of U.S. liabilities by pushing back and verbally communicating their desire to switch gears and go in a different direction. And in doing so, every nation that China partners with will eventually do the same. So you got the BRICS. The BRICS, Brazil, Russia, India, China, South Africa, and all the global partners that are signed up with them, they're eventually going to do the same thing. Because once again, if China isn't holding U.S. liabilities, therefore China will not be accepting anything in payment other than renminbi or yuan-based debt or currency. So all of their partners will eventually have to convert U.S. liabilities and debt into the yuan-based instruments, especially given the fact that China is trying to open up their markets and using the yuan for trade, because they've made it clear. I'm not quite sure if I mentioned this, but the yuan for international trade, there was an article came out last week that referenced that China's ready to place the yuan as a international medium. So let me grab this. Where's that? Strong mission to run around. Okay, so here's just something. This is a week ago. And so stuff like this, it further puts nations on a warning that you don't want to be holding U.S. liabilities, especially when you have potential alternatives beyond U.S. debt. So here, this is last week. It says China is on a strong currency mission to make the yuan a global reserve, and it's quoting Xi as saying this. It says Xi Jinping says the goal of becoming an international powerhouse is a long-term one and will rest on core foundations. So here you have Xi mentioning the yuan, strong currency, global reserve. So this plays into more of the need to begin lessening your exposure to another nation's problems, which is our currency. And so what used to be, I think it was Henry Kissinger said, the debt, U.S. currency it's your problem and our asset, or something like that. You guys, might be familiar with that. But here we are now. The dollar is our problem, and it's the world's decision to get away from it. You kind of get my drift in a sense. So that's just something to consider there. But it doesn't stop there. So I pinpointed a couple of other things that I want to touch on that really hits at its core. Give me a second. Let me grab what I wanted to touch on here, because outside of it becoming public knowledge, we have lots of other individuals that are shining light on the subject matter in reference to what is preferred. So on this chart here, I'll give it to you. We can see that this is nothing new. It's just the narrative is starting to become, I guess, allowed from the Western media. So here's a graph showing exactly what they've been doing for quite some time now. And so in the red, as you can see, US Treasury exposure has been rolling over incrementally for the last several years, while at the same time, their gold position has been steadily upticking. So literally, it appears, based upon this chart, that as they divest out of U.S. liabilities, they're taking that currency that they receive from giving back the debt. They get compensated in a U.S. debt currency. They take it and obviously either reinvest it into all their African projects, or they just buy something real in the form of gold. So it's no coincidence that as their treasury exposure is wind down, their gold intake has increased. And so this is just a chart, for the most part, confirming that. So this is something that I want to touch about. So this is some global markets here. And I'll give you a little bit of this narrative here, but it once again highlights more and just emphasizes where the currency is flowing. It says Chinese officials have urged banks to limit the purchase of government bonds and instructed those with big exposure to sell their positions. Says the directive doesn't apply to China's state holding of treasuries. So the government still holds their initial reserves in some treasuries, very small, as you can see in our chart. But it's the institutions within the country, the banks, the hedge funds, the investment firms, they're told you start unwinding yours. It says most recent data shows that China's holding U.S. government dropped by 6.1 billion in November to 682.6 billion, the lowest since the financial crisis. So literally, they're at financial crisis lows with far as their holdings. So since 2013 peak, the country's holdings have fallen 634 billion. It says at the same time, China's central bank extended its gold buying streak to 15 months. So literally, from 15 straight months, as they've been selling debt, they've been accumulating gold. So it's good to say a good chunk of those proceeds from selling debt has been rolled into accumulating more gold. And this is just what we're being told. This is stuff that they go out on the open market and they buy. Not to mention what's mined within their countries and what they receive from other nations directly. This is just what the World Gold Council is able to report. So the People Bank of China added 40,000 troy ounces or 1 ton in January. So literally just 9 days ago, 1 ton or 40,000 troy ounces of gold was put into their vaults. And so for the average Joe and Jane who may not really see or recognize all of this gold accumulation, you clearly have to begin wondering, why would China be so infatuated with accumulating so much gold unless they have a plan or they want to reinsure themselves or protect themselves from what is either underway or what they see coming. And that's the part where here as a citizen within the United States of America, as I'm watching China position for whatever they are going to initiate or whatever they think is coming, it only makes me more concerned about me basing my entire life around something that they're getting rid of. And as of right now, those that are paying attention and those who might watch the replay, we're the holders of these things. So if they're concerned, shouldn't we be concerned as well? And that's why, once again, I take all this information, I log on, I try to make sense of it, filter through the noise to give it to you straight. Because if you watch just mainstream media, they're going to tell you buy and hold. Look at the stock market. Oh, every time it takes a dip, that's a great buying opportunity. But once again, it's priced in the very same thing that is being reconsidered. And therefore, the purchasing power of that unit will only continue to diminish, and it'll make things around you appear as if they're increasing in value, but actually it's just the need for more paper units within those things that gives it a fake value. And so just look at the Venezuelan stock market or any Zimbabwe. So anytime there's an extreme inflationary environment, stock markets go to highs that we can't imagine in nominal terms. But if the currency is not worth anything, if you go to cash out or to take some chips off the table with those stocks, you're getting back a currency that is worth way less, to where it provides you no store of value whatsoever. You can't store value in stocks that are overly priced anyway. And so literally you need something that serves as an insurance policy against the currency. So we're past the point of really considering investing according to the old model, a way of protecting yourself, because just getting involved in and taking your current currency and putting it into stuff and looking at a screen and thinking you're getting wealthy is an illusion, because it's the currency that's dying that makes it appear as if everything is going up. So in actuality, you're still in the same game that they are using against you. And when you get into gold and silver or land or anything tangible and have something physical that you hold, those items are the measuring sticks, or they're the anchors of stability. And whatever they are priced in, that's where you can either cash out or you can remain in those things and you'll be shielded. It's like it's like literally taking out an insurance policy on your own currency and your financial products, 401ks, IRAs, annuities, when you hold something physical in your possession, Hopefully that makes sense a little bit. Okay. So let me just give you a little bit of this narrative here about what's going on. It says after they accumulated 40,000 tons in January, it says this brings the total gold holding up to a record 2,300 tons. And this is what we're told. This is not reality. They have more than 2,300 tons of gold in their possession. It says the trend is clear. China is diversifying away from the U.S. dollar. And from this chart here, we can see that that's quite obvious. So don't just see what they do, learn from what they do, and set up a process to kind of mimic their actions. So if they're not willing to hold large amounts of U.S. liabilities, I believe as citizens, we have the right as well to reconsider how much we want to hold in proportion to what we believe we'll be able to actually use in the future. And knowing that when the QE starts officially, you know, yeah, the hold of the fiat currency are the ones that lose all the value. And so let me give you some more here. There's something, let me find this. So speaking of QE, let me share with you reserve management, which is what the Federal Reserve like to call it. And let me see, we got 8. Let me see if I can find it. Let me see if I can find it. I didn't have this ready, but we're going to have 8 or so billion. The Fed is back in the game of buying debt. And as more nations dump debt, there's going to have to be a buyer. So the Federal Reserve will definitely step in on top of whatever third parties they contract through. Give me a second. Let me shoot. Where's it at? I'm trying to may not be able to find it. I should have had it ready. But bond purchases, because this was a number. Let me see if I can find it in time. Will I be able to find it? Okay, no, this is old. Frick. Let me see bond purchases. Okay, here's something. Is this it? Bias. Yeah, this is related to some things. So okay, now I'll just skip that because I waste too much time. But my point was I was trying to find the actual dollar amount of which the Federal Reserve decided to go into the open market and to purchase U.S. liabilities as a way of their reserve asset management, which they mentioned, Jerome Powell mentioned in December when they stopped QT and began QE. It's not QE, but it's reserve management control. That narrative is QE. And so literally, the Federal Reserve is going to be buying more and more as more is put into the market. And that's not including what our government has to issue to pay back just the interest on what's due now, which is $8 or so trillion. And so where is that going to come from? How will they repay or refinance $8 trillion ish within the next couple of months? They're going to have to issue a lot more. And so therefore, that's more currency created out of thin air that will compete against your savings, that will compete against your check that you receive from your employment. Because your employment check, whether it's, fixed, whether, your salary, hourly, or whatever, that number will not grow nowhere near as fast as what the Federal Reserve is about to create. And that's why, for me, I look at it as whenever I get extra, I'm getting into something physical to get out of the harm's way of my currency losing purchasing power, because it's good to say you won't be able to purchase nowhere near as much as we move forward as you can today. So today is probably the cheapest actually being able to get physical anything, and in particular silver, will ever be, barring another slam down or something like that, because of the currency that's going to be created. So as I just let me just look on the screen. So here's the tricky part. As we look at the spot price, according to what we're being told at this current moment for an ounce of silver is $82.72. That's what we're being told, and it's ticking upwards. But if you go online and try to find something, what you're going to end up finding is that this is what you're going to end up paying. You're going to end up paying something to the tunes of right here. This is what you're going to be paying when you go to check out using a card or PayPal online. So $82 spot, $96 for an ounce within 1 to 20. So that premium there lets you know it's $14 premium. So no matter how low the physical spot price goes, every dealer that's in the business of making money, they're going to definitely make up on that premium. So right now, technically speaking, if I want to go online, silver is $96 for 1 ounce. And if I wanted to have it shipped to me, I'm gonna pay shipping and handling. So that's another $7+. So you get my drift. Right now, silver at $82 on the spot price is the cheapest that it will probably get because the premiums will make up the difference. And so that is just a little something to keep in mind. So get physical, get your weight up, do what you got to do because literally that silver price is not real. Now let's talk about the crypto space because the crypto space, I believe, is another sector where we're going to also see more activity in that. So as you can see right here on the screen, we have Bitcoin at 69, and we have all the other projects around it is also a little bit in the red. So let me refresh my screen here. And the reason I'll continue to talk about this is because when the spigot is cut on, or when QE officially begins, any and everything that has properties, monetary properties, will definitely be a recipient. And we know that a lot of this Bitcoin manipulation is intentional so that bigger players can get involved, bigger banks can get involved because they found ways to control the spot price of that as well. Because whenever there's a surge of people buying, like Sailor bought, 1,200 Bitcoin a day, and the price is stagnant. So you got to ask yourself, how, with such limited supply available, are they able to keep the price contained with all this buying or selling? Clearly, the exchanges are all working in cahoots and selling off chain or over the counter or paper Bitcoins as well. So, but then again, it's intentional. So when the banks are ready, they're going to let it rip. When it rips, everything associated with it will also go up as well. And so, well, that's one guarantee. The more currency that's coming, which it is coming, everything that's labeled as a monetary medium will be recipient of that currency. So position yourself ahead of time if that is something that you foresee coming, is something that you want to definitely consider. And then we have it says dropping gold. I assume you mean that, Mike? I'm not sure about. Let me know what that is. And it says never get notified when you are doing a live stream. I would just say, Mr. Smith, hit the bell. Hit the bell. I mean, once again, it's one of the things where I tell people make sure you hit the bell so that you are notified. Click all. So hopefully YouTube do what they say they're gonna do, which is notify you. So I apologize for that. But yeah, I try to connect early mornings around between 10 and 11 to bring some insight, bring some thoughts towards what's happening, just to keep you guys informed. So once again, it's my way of trying to make sure I stay connected with the community. And if you found value here, I just I connected, shared everything. If you catch the replay, drop some comments, some thoughts down below. And yeah, just checking real quick, let you know what's happening. More de-dollarizing, more dumping. And so watch what China does. And you should build a model for yourself or a framework on how you will also reposition yourself, because this instrument here will be your greatest financial liability in the future, because every single currency returns to its intrinsic value, which is zero at some point. And you don't want to be holding a bag, but you do want to hold something tangible, preferably something that shines bright. Anyway, just checking in, man. Enjoy your day. Be blessed, be safe. And yeah, love, live, learn, laugh. And if you haven't subscribed, hit that bell.